Hey, what's up, my friend? So in today's training, I want to share with you moving average mistakes, right, that almost all traders make, right? Even I myself included, I've been making these mistakes, right? Some of these mistakes for 4+5 years, and only then I realized, man, how silly I was. So hopefully that won't have to take you 4 years or 5 years, because I'm going to share with you right now. Mistake number one: you think that there is a best moving average out there, right? There are often, right, traders come to me and ask, hey Rayner, which is the best moving average out there, right? Is it the simple moving average? Is it the exponential moving average? Is it the weighted moving average? Or how about, hey Rayner, is the 50 period moving average better than the 20 period moving average? Oh, I heard the 200-day moving average is respected, right, by many people in the trading community, right? Maybe I should pay attention to it, right? So which moving average is the best, Rayner? Now here's the deal. There is no best moving average out there, and I'm going to prove it to you right now. Here's why. If you look at this chart over here, okay, it might seem that, hey, the 20 period moving average seems like the best one over here for this market, right? The 5-year treasury note futures, right? You can see how the price retesting the 20 MA over here, here, and here, right? That seems like the best moving average. But then when you go into, let's say, a different market like euro dollar, in this case, it seems like the 200 period moving average is the best one over here, right? Clearly this market respects the 200 MA right over here, here, over here. Wow. Or how about this, right? If you look at the China A50 and you see over here at this point in time, it might seem that, hey Rayner, the 50 period moving average seems like the best one over here. So can you see where I'm coming from? Is that there is no best moving average out there. The secret is this, is that you want to pay attention to the price structure first, then use the appropriate moving average for it. So what do I mean by this? So let me give you an example. If you see a market in a strong trend, right, the trend is strong, the pullback is shallow, chances are you want to use the 20 period moving average because it's more responsive. It can help you better, time your entries. For example, if you look at the 5-year treasury note futures, you can see that right now, this market is in a strong uptrend, right? The pullback is relatively shallow, and that's why the 20 MA is a good fit in this market condition, right? Shallow pullback, shallow pullback, shallow pullback. Can you see where I'm coming from? I'm not trying to find the best moving average out there. I'm trying to understand the current price structure of the market. I'm trying to understand the current market structure and then use the appropriate moving average for it. Or how about if the market is in a weak trend, the trend is not very strong, the pullback is deep, which moving average should we use? Something like, let's say, euro dollar, this market over here. You notice that the pullback, they are relatively deep, right? Notice the depth of the pullback, the pullback. This huge one over here. So that's where you want to use a longer term moving average, like the 200 period moving average. Does it make sense? Okay, so here's the deal. Okay, there is no best moving average out there. First and foremost, you want to understand the current market structure, because once you understand the current market structure, then you know which would be the best moving average to use for that current market condition. And here's the kicker, right? Here's the kicker. Let me just give you an example over here, right? You can see that the market structure, okay, or rather, let me give you this one over here. The price structure, the market structure, the trend structure in the market, it's never static. It's always changing. That's why you see the market goes from an uptrend to a downtrend to a range, etc. Same for trending market. It can be in a healthy trend, goes into a strong trend, or becomes a weak trend. For example, if you look at the 5-year treasury note futures, at this point in time, right, it might seem that this market is in a healthy trend, right, respecting the 50 period moving average, tested once, twice, thrice, 4 times over here. But remember, I said that the trend structure is never static, it's always changing. Then you can see that it has evolved over time. Right now, it has picked up, right, and the trend now has strengthened. And it seems that right now, the 20 MA, right, is a better fit given this current trend structure at this point in time. Okay, so this is important, right? There is no best moving average out there. What's important, right, is to understand the current market structure and then find. And then once you understand it, right, you will know which is the best moving average to use, right, in that market condition, right? So that's the first mistake, right? Traders thinking that there is a best moving average settings out there. Mistake number 2, traders use moving average crossover to time your entries. When you do this, right, you're always one step behind, sometimes even 2 or 3 steps behind. Right, let me give you an example. Here's the thing about moving average crossovers, right? So if you look at this chart over here, okay, this dollar against the Mexican, and some of the popular moving average crossover is, the 5 cross the 10 period moving average, like this. Okay, so in this case, you can see that when the red one over here, this is the 5 period moving average, and this is the 10 period moving average. So if you're looking for short signals, right, you can look to sell when the 5 cross below the 10 period moving average. And in this case, right, this is where the crossover occurred, where the 5 period crosses below the 10 period moving average. And when that happens, right, you'll be looking to sell at this next candle open, right, if you were to, use it to time your entry. And you can see that it's pretty late because the market has already, moved quite a bit down lower. And that's the thing with moving average crossover. It always lags, right, compared to traders reading the price action of the markets, or trader, relying on, candlestick patterns to time their entry. Those traders will always be faster compared to a trader who relies on moving average crossover. For example, if you look at this chart, right, to an astute price action trader, they would consider this a false breakout where the price takes out above these highs, reverse and close near the low. So this is a false breakout. Some traders might even call this a shooting star pattern, and it could go short on the next candle open, which is this candle over here, on the next candle open here. Can you see the difference between someone using moving average crossover to time their entry and someone reading the price action, right, to time their entry? A big difference. So if you're a discretionary trader and you're relying on moving average crossover to time your entries, you might want to, reconsider that technique again, right? There's a time and place for moving average crossover, but not so, right, for discretionary traders, because price action traders, right, they'll always be, one step ahead compared to a trader who relies on moving average crossover. Here's another example. If you look at this oil market, okay, so if you look at this again, when you look at this chart, to a price action trader, this again is a sign of price rejection. Price took out these highs, got rejected strongly and closed near the lows below this area of resistance. But for a trader, right, who relies on moving average crossover, where will they enter the trade? So again, if you see this 5 and the 10, they will go short somewhere about here. Okay, somewhere here on the candle, on the open of this candle, somewhere here. Can you see the difference? Price action trader selling somewhere here, moving average crossover trader selling somewhere here. You're always slower, one step behind. Or how about this one over here? Another one at this highs. Okay, we have this price rejection over here, here, and here. To a moving average crossover trader, they would enter somewhere when the price, right, when the 5 has crossed below the 10 period moving average. Again, it will be somewhere at here, this open. Somewhere here at this open. Again, just one step behind. So again, my point is this, is that if you want to time your entries, right, consider learning how to read the price action of the markets. You'll be faster. However, as I mentioned earlier, there's a time and place for moving average crossover, and that's where you're adopting a trend following approach, a systematic trend following approach. Then fair enough, you can use moving average crossover to time your entries and exits, right, and to ride massive trends in the market. But if you're a discretionary trader, I would say this technique won't be as beneficial to you. The third thing, right, this is an important one. You're trading far away from an area of value. You're trading far away, right, from the moving average, right? And when you trade far away from the moving average, this is when the price is about to make a pullback, when it's about to make a reversal, right? So let me explain to you what I mean by this. So if you look at this chart over here, this is a Nasdaq. Okay, you look at the weekly time frame, you can see that Nasdaq, right, seems to be, respecting the 200 MA. Why is that? Well, that's because of this current market structure. This market seems to be in a weak uptrend, right, on the weekly time frame, right? The pullback is relatively deep, right? If you look at the depth of the pullback, it's deep, right? Deep. So at this point, right, what I'm trying to illustrate is that where is the area of value? The area of value clearly, right, is around the 200 period moving average, around here. And a mistake that many traders make is that they look at the chart and say, oh, the market is in an uptrend, I should be buying. But you don't just want to buy when the market is in an uptrend. Because if it's far away from an area of value, number one, your stop loss is going to be huge, right? If you're going to set a proper stop loss, it has to be huge. And number two, right, you're entering when the market is about to make a pullback or reversal. So if you look at this right now, ask yourself, where is a logical place to set your stop loss? If you ask me, right, the logical place is at least below this swing low over here, below the 200 MA, somewhere here. Because it doesn't make sense to put your stop loss here, 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 or here, because there is no price structure, right, to support these prices. The market can just swing down lower, right? The nearest area of support or resistance, area of support or swing low is here. This is the nearest one. And if you want to reference this to set your stop loss, right, the bare minimum, right, is at least at this level here. And if you look at this, right, from here all the way down to here, that's a pretty darn wide stop loss. And that's why I said that when you are trading far away from an area of value, right, number one, the odds are not in your favor because, you know, the market is primed for a pullback or reversal. And number two, right, your stops are pretty wide and that doesn't offer you a favorable risk to reward on your trade. Okay, so let me give you one more example. Euro dollar. Again, this is a chart you should be familiar with. And you look at this. Again, you can see that the market respects the 200 MA. This is the area of value. And a mistake that many traders make is that they will look at this chart. Oh, Rayner, the market is in a downtrend. Let me short this market. Let me sell. And then they look at this pattern. This looks familiar. This looks like a bear flag pattern. Let me short the breakdown of this bear flag pattern. But if you understand area of value, if you know where the area of value is on your chart, and you realize that the price is actually quite far away from the 200 MA, you might not want to sell at that point. Okay, because two reasons again. This is where the market is prime, right, for a pullback, a retracement, or even a reversal. And number two, to have a logical stop loss in place, right, it has to go at least above this 200 MA. When you place your stop loss, right, anywhere from here down to here, anywhere between here, there is no area where selling pressure is likely to come in and hold down these lower prices. Because as you've seen, right, the area of value is at the 200 MA. This is where selling pressure, right, has been shown, right, to exist and push the price lower. Here, 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 and possibly over here. So this is where, you know, you want to be selling at that area of value and not far away from it. I hope that makes sense. So that's the third thing, right, that many traders make. They trade far away from an area of value. So let's do a quick recap, right? Number one, there is no best moving average out there because it doesn't exist. I've proven it to you. Because it all depends on the market structure, the trend structure. And here's the thing, right? This market structure is never static. It's always moving from, you know, uptrend to downtrend, range, strong trend to weak trend, healthy trend, etc. Number two, don't use moving average crossover to time your entries. This is especially so if you're a discretionary trader, because a better approach to time your entries is using price action of the markets, right? You will get into your trades faster. And finally, you want to trade near an area of value and not far away from it, because when you trade far away from an area of value, number one, your stop loss is wide if you are, you know, using a proper stop loss, and number two, this is where the market is prone to do a pullback or reversal. Okay, so trade near the area of value, right? Moving average can be used, right, to help you define the area of value, and yeah, trade near it and not far away from it. So with that said, I have come towards the end of this video. I hope you got value out of it, right? If so, smash the thumbs up button, subscribe to the channel, the link is all below, and I will talk to you soon.